Hello everyone. The investment approach of the fund is to generate long-term capital appreciation on risk-adjusted basis from diversified portfolio predominantly focused on ownership of large and mid-cap equities and equity-related securities. Few ethos that we follow towards fund management side are: the first one we follow is fair investment philosophy in managing fund. FAIR stands for forensic, acceptable price, ESG informed, and lastly, the robustness of the business model. These tenets are beacon of light for us and we breathe them day in, day out. We cannot emphasize enough on the fact that this philosophy helps us in minimizing subjectivity as well as orient towards objective assessment, which help us over longer run to achieve risk-adjusted alpha creation. The second tenet I like to talk about is the bottom-up stock selection approach. We trust our ability to assess fundamentals of business across sectors and finding the best fit at overall portfolio construction level. This approach serves dual benefit of creating room from alpha generation within the relative sector you're talking about and gaining advantage of portfolio diversification. Last but not the least, no or alternatively minimum cash call. We believe that at asset allocation level, our investor has already taken informed view towards various asset classes, and hence our aim is to generate alpha by staying invested in the market. Hence, we like to keep our cash balance at the minimum level so as to staying invested for the maximum duration of time. We don't hold very strong view on macros and don't try to second guess how things will pan out on that level. Our portfolio construction approach is oriented towards certainty of earning versus pace of earning momentum. Quality of growth has far deeper impact on long-term earning and hence finding businesses which are compounders, which can generate return more than cost of capital, optimal free cash flow, consistent business performance, and have long runway of growth ahead of us. At this juncture, I like to highlight we prefer businesses that are more domestic oriented versus global exposure. This thesis is backed by a belief that Indian economy is about to face a virtuous cycle of gross fixed capital formation, led by already announced private and public entities capex and further enhanced by the benefits of PLI benefit-led capex cycle. Another aspect which we like is financiers and lenders. After having seen tepid credit growth and tumultuous asset quality for the past few years, they are about to reap benefit of higher gross fixed asset creation, translating into accelerated credit growth and a stable asset quality, higher disposable income of households, backed by strong wage inflation, as well as the quarter-led savings of pandemic, translating into higher discretionary and real estate boom. And lastly, what we like is clearly the disruptor on the technology front, which could be within manufacturing or automobile space, which can lead to emergence of new world leaders. Recent changes are in alignment of our economic outlook and emerging opportunities that we foresee, as we have mentioned earlier. To start with, we have been increasing our exposure towards mortgage financiers and home financier companies, backed by our belief that we are on a cusp of virtuous cycle in real estate and a higher affordability factor can further lead to strong disbursement growth. Second theme which we like, IoT 4.0 is gaining prominence and we have seen aggressive comments towards industrial automation and data center rollouts. Greenfield capacity addition of heavy industries such as steel, cement, refinery made us increase our position to already existing overweight which we have in industrial capex recovery play. Another factor which we want to highlight is recent geopolitical quagmire has resulted in pressing needs of self-reliance and high indigenization of defense capability. We have seen recently 3 lists which have come from Ministry of Defense emphasizing on aspect which leads to restricting imports of equipments and platforms mentioned in those lists. We have increased our exposure to name which we believe will be direct or indirect beneficiary of this initiative by the Government of India. We have had good end to the last fiscal from performance perspective. We believe our superior stock selection ability within spaces like financial, automobile, utilities helped us to generate positive alpha despite being underweight the sector on average for the whole of past year. Consistent overweight throughout the year in capex related sectors like construction and industrial helped us to generate positive alpha at the overall fund level. Lastly, looking at how volatile last year has been on geopolitical front, we abstained from taking huge bets either side on commodity from a producer or end user perspective, and that impacted our performance negatively. Happy investing. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Visit www.edelweissmf.com